the next section we want to cover is really about our insurance philosophy. And you will realize that a lot of this philosophy is very consistent with what Chris has shared. Fundamentally, we are aligned. But let me talk about what is our view of insurance in terms of whole life term, in terms of ILPs, in terms of endowment programs. So in my section, I will be sharing that philosophy. Most of the information can be found in the ebook that I mentioned earlier. So please download it and get familiar with it. So first thing I want to talk about is insurance is not for savings or investments, but for protection. The primary purpose of insurance is really for protection, not savings or investments. And because it is for protection, it is an expense. And really we want to, if it's expense and it's a cost, we want to spend as little as possible and to get as much coverage as we need. Because if we are able to reduce our insurance premiums, all right, we are able to have more resources to enjoy our current lifestyle, have more resources to plan for the future. But do you really need term or whole life? How should you decide whether whole life is suitable or term is necessary? In order to answer this question, we really need to understand the role of insurance in our financial journey. So let me illustrate that with a simple timeline. We are here and now here, right? And in the future, 55 to 65, this is a time where we are aiming towards our retirement, to be financially independent. So right now, we do have accumulated some assets, some resources, depending on our life stages. We have some assets that could make up from our cash, our CPF, our investments. And as we move from young accumulators, as we progress in life, we could be buying a house or form a family with responsibilities. So this is where we are right now. And as we move towards our retirement, we have to work to earn an income, and through an income, create a budgeting process to save enough and to invest our savings to grow our current assets into these future assets that will fund our retirement obligations such as children's education or some gifting goals. In order to fund our retirement over a period till about 85 to 90 years old, 85 typically for men and for 90 years old for female. And this is really the plan A of our financial plan. We really want to accumulate in a systematically way so that we could retire. And this is plan A. And in this diagram, you notice that the most important assets is your income. We need to depend on income in order to retire, right? Otherwise, we could just stop work and retire. We still need to depend on this future income to grow our assets. So what is plan B then? If this is plan A, what is plan B? What can cause this financial plan to fail? We are very familiar. If income stops, then the plan will fail because income is an important asset that we need to build our financial wealth. What can cause income to fail? 3 areas: death, medical crisis, as well as disability. And this is really where insurance comes in to protect these events that would derail our plan A, financial plan. When this happens, current assets will deplete and it will affect our future assets. All right, back to the questions about do you need a whole life or term plan? The question is, how long do you need that coverage to protect the areas of death, this medical crisis, and disability? Do you need to protect, if the need is to protect over a certain limited years, example, till retirement age, all right? Then that is what you call a temporary need. The need for insurance is temporary. You don't need throughout. If the need for insurance is throughout, then it is a permanent need. Regardless of where you are, you need that insurance coverage for that purpose. Now, let me move on to another category, whole life plans. I've covered a little bit of it in my earlier slides. So, you notice from my earlier slides that for whole life plan, it is only applicable for limited scenarios. And even so, it is usually not the highest priority for most people. So it's more important to cover all the term needs. And if there's extra resources, and if there's a need, you can actually look into whole life. But that is not the first priority. There are three particular scenarios. I have highlighted two: alternative medicine provision as well as legacy giving. Another use case for whole life, which we think is appropriate, would be buying a small critical illness plans for newborn, because we know as parents sometimes we are very concerned of children that as they grow up they could suffer conditions, medical conditions that prevent them from getting a plan. So for this kind of concerns, yes, we do recommend a whole life plan for the kids. Usually a small amount, and you shouldn't be taking too much money, too much premiums to fund this plan. So that is our view for whole life insurance. It is we don't need the whole life for most situations. Okay. So how about ILP? We do not recommend ILP because why? Because the primary purpose of insurance is not for savings or investment but for protection. Therefore, we do not recommend ILP. And another reason is because when you talk about investments, there are many options for one to invest in. And there are lower cost options out there, many platforms available. And therefore, we think that investing through the insurance ILP is a costly thing, number one. And number two, there is a restriction in the fund selection. Okay, the fund selection may not be sufficient for you to express your portfolio construction to achieve your investment goals. All right, so there is a restriction on the fund choices. And thirdly, insurance contracts are long-term contracts. So meaning that if you buy ILP and for whatever reason you need to liquidate it, okay, there will be a high surrender penalty that is imposed on the ILP, the investment plan, which otherwise, if you go into a pure investments, there is no such a penalty. So for Haven, we do not recommend ILP. Lastly, I'll talk about this product, endowment or retirement income plans. We are not against endowment or retirement plan because for some people who are very, very conservative, who rather put money in the bank as savings deposits, right? Endowment plans could be a possible options. I know I may be conflicting myself. Just now I mentioned that the primary purpose of insurance is for protection, not savings and investments. But now I'm talking about endowment plans. But really, endowment plan is not meant for everybody. It is suitable for people who are very conservative savers, who would not want to invest their money beyond putting money in the bank. Okay, so I think for this kind of category of clients, endowment plans can be a alternative for them. Okay, but they need to know that the returns is not as fantastic as otherwise investing into the normal investment platforms. But before putting money into this, endowment and retirement income, our advice to them would be to maximize what is available in the market, risk-free rates. Okay, and what it means is to first of all top up your CPF, at least to the full retirement sum. All right, because this is where you can build your retirement assets at a very high and guaranteed return of at least 4%. Okay, and even if you are looking at very safe options, short-term options, there are options like Singapore Savings Bond, SSBs, or T-bills, where we can get a very decent return, okay, on your savings. So beyond considering this, and if clients have excess resources and they want to consider growing money beyond bank's returns, well, you can consider endowment or retirement income products.